Welcome to The Bridge by iCapital. I'm Sonali Basak, the Chief Investment Strategist at iCapital, and today I am joined by Mathieu Chabran. He is a co-founder of Tikehau Capital, which has about $60 billion in assets under management, and it's a really great time to talk to you because there is so much going on in the private credit space. This is a place that you really have cut your teeth in many, many ways, but you have unique views on what's going on, so let's unpack it. If you look at private credit on one hand, there's large institutional fundraising, but there are a lot of questions around the retail flows given the elevated redemption notices we've seen across the industry in the first quarter. Dissect it for us.
I think the private credit maybe noise struck me as people forgot that in credit there was a risk associated with that, right? So the underwriting, the fact that you have to work with managers who've been there a long time. And maybe the issue we had maybe with part of the retail investors is because they came in late around COVID. Remember when interest rates were at zero, spreads were really tight because the Feds and others were there, and then they found a way to do effectively 6, 7, 8% return there. Then fast forward, a little bit of the asset liability mismatch in part of the market. A little bit of some people, freaking out because they saw that there was a part of the market that was being, repriced, and then we had, a moment of panic. I don't know if it was more noise than effectively panic, but it reminded me of the tech bubble, 25 years ago when we started, and we were working this left fin, and we saw some investors effectively defaulting because that's what people did not realize. That's the risk that is associated with credit. Is that yes, there can be some default, and I think it's healthy. Actually, I really believe that what's happening right now is healthy because, as you said, very strong institutional demand. I think that part of the market who came in maybe late, then now might be reassessing their view about the asset class. But fundamentally, that's the basic of what we do. Lending money. And so if you do it well, I think there will be some great opportunities.
So very curious about this because outside of the institutions, the individual investors, the data did show that the redemption notices were still fairly concentrated. It wasn't that there was widespread heading for the exits. It was a concentrated a set of investor bases and concentrated funds. So what does that say to you in terms of the ability for the sentiment to shake out this year? Do you think that we'll get to the middle of the year and we'll look at the first half of 2026 and it was yesterday's news, or do you think that the sentiment is going to take a while to flush out?
No, I think it's going to take a while, for the very reasons that effectively a lot of people, try to rush, through the exit door. Now, having said that, the new vintages, what is being put at work, right now, I believe are going to be, much better because people effectively woke up to the fact that maybe there might have been some excesses, in some part, in terms of leverage, in terms of documentation, in terms of maybe complacency, in some part. And when you have a wake-up call like the one, some people had, I would expect the new vintages starting now to be actually much more robust.
So there's something counter-cyclical, it feels like to me, about investor behavior and how the funds are doing. And how do you convince people, okay, well, wait a minute, there are some vintages, right? The vintages people are worried about are the ones pre-2022.
Of course, yeah.
And so now, if we believe that 2026 is going to be a good year, how do we explain that story? Why is this year a better year than those years past?
Discipline. I think that it always comes down to discipline in the underwriting, discipline in the distribution, discipline in the skin in the game, something that is very important. Because when I said, there were maybe a bit of complacency, I really mean it. Because we were coming out of this, mega cycle of 15 years of very accommodating environment that was that was actually beefed up by the post-COVID liquidity, that got into the system. And so effectively at some point, this extra marginal liquidity that may not have been here in the first place, it needs to be reassessed and repriced. And I guess that's what we're going through. Now, there might be some structural changes, I'm sure you will, we want to discuss the software and other stuff like that. But when it comes down to credit and lending and direct lending and private credit, the way it's been operating for a long time in the US, less so, in Europe, in other part of the world. I think it's a maturity phase. And yes, it will certainly be yesterday's news, but the market should get back to a more healthy, I think, a more healthy environment, which will be great for investors, which will be great for managers, and fundamentally, which will be great for the economy.
Yeah, you make a great point because people forget 2020, in the wake of what had happened with COVID, it wasn't just that there were low interest rates that rose very precipitously in 2022. It was also life support. There was a Fed that had a bloated balance sheet propping so much liquidity into the market. So when you think about the current opportunity, there's a lot of people who are saying that this might be the year that we might actually see dispersion among credit managers. Do you believe that that's going to be the case?
Yeah, it will. For sure. To start with, you're right. There was a very visible end of the market. There was the Fed. That what I like to call it, the very visible end of the market, because they were the buyer of last resort, and so you knew that part of the spreads, had been artificially maybe. There's been this distortion. But when you look at the situation, where we are, right now, this reset, in the market with now a more mature industry. The fact that, as you remember, I remember this number where 95% of credit managers were born after the GFC. I'm old enough now to know I was born before that. We started in 2007. And effectively, you're in this situation where people thought that it was easy because it was called credit. It should be, easier than doing, large, big private equity deals. But all that, ties together. And you've got the managers, very well established, who've been there, decades. And as the market developed, they started to, marketing these new strategies to a new investor base. This investor base is learning too. But if this situation, this moment in the market has some benefit, it will be to make the market, as I say, more healthy. But I would expect the real proper disciplined managers, to take advantage of that. And you started seeing that actually in the numbers. As you said, a lot of institutional demand support, and the large platforms are still operating very well.
So let's be super specific about the lessons learned then. To the extent there's some behaviors that might get washed out of the industry because of what we've seen this year, what are those behaviors?
Yeah. Well, firstly, the asset liability mismatch. Here again, we've been discussing that, at length. The evergreen format, is a great way to access the product, but it has to be understood by the investors, getting there. It has to be properly managed by the GP itself, because you've got some constraints on this vehicle, but it has to be, properly managed and not trying to maximize everything. Both the size of the fund that you're raising, both the return, the leverage. It comes down to good sense. I think when you start, with this structural fund, which fundamentally is not designed to receive, private assets.
So I'm really interested in diving into those because I don't think people are talking about it enough. On one hand, there's that 5% liquidity cap that I think now is better understood after we've seen this cycle. But you bring up two other points that are very important and less are talked about. One is within these evergreen vehicles, a close watch on leverage is one of them. And two, also not growing too fast.
But because when you grow too fast, Sonali, you have to put the capital at work. And it's complicated to invest, So raising money is one thing, and if you're successful at that, then you have to deploy. Because remember that when you've got this cash coming in every week, every month, if you don't put it at work, that will dilute the existing portfolio, right? So there is some kind of a bias forcing you to deploy and maybe being less discipline. So that's also the other part. And that's why I come back all the time to the alignment of interest. You want to see more skin in the game from your managers. And that for an investor who is now reading about this and saying, well, was it noise or is there an opportunity? That's the first thing you should be doing. Are you investing with someone who's got an incentive to be patient and to asset select, or are you investing with someone who's got an incentive to deploy? And that makes a huge difference.
Yeah, this is an interesting point here because I think conventional knowledge knowledge in the money management world was raise a lot of money, get much bigger. But realistically speaking, you're saying that there's a real benefit here to being disciplined in how you raise money, actually.
Of course, because you've got this pot of cash coming in, diluting the existing performance, and you get this constant and consistent, incentive to deploy and maybe being less, again, disciplined in your underwriting. And so, effectively, when you say about, it's not about being as big as possible, and that's why you also have to be careful about asset aggregators, if I may say. You want to remain with the investors. And if you do that, there'll be great opportunities this time of the cycle.
So the fun part of this conversation is now, what are you doing about it? How are you using this moment to find opportunities if we think that 2026 is going to be such a great vintage?
Well, to start with, we're very active in private debt secondaries, right? We started that 5-6 years ago, at the time of COVID, and it was not really tested beyond the institutional LPs effectively arbitraging their portfolio and selling at times, and us providing liquidity. As you can imagine, that's going to grow, it's going to balloon, because some people are panicking, some people are rebalancing, some people are arbitraging, and being able to provide the liquidity to these people who are looking for effectively part of the liquidity, it's a massive opportunity right now. Because if you look at what happened to secondary private equity over the past 20 years, that has become such a big established strategy. Private credit secondary will follow the same trend, but at a multiple, because there is, twice or 3 times more debt in any given deal than equity. So the volumes are going to be bigger. The investors who put a lot of money into the primary market over the past 10 years, they're looking at rebalancing. They're not selling because it's distressed. They're not selling because themselves are distressed. They're selling because they want to rebalance. And this is, in my view, one of the biggest opportunity we've seen over the past 2 decades of a new asset class into something that is very basic, which is this credit market.
So this tells me that if you're comfortable buying the private credit secondaries, and are these mostly LP-led or GP-led?
LP-led is what we are focusing on. You do both, but LP-led is what we favor.
So if you're buying the assets, it tells me at least that you have confidence in the credit underwriting.
Of course. Or you redo your underwriting, because effectively when you're buying an aged portfolio 3-5 years into the deal, it's very different from what it was 3 years ago, but that's where you are the price setter. Primary market had become a market of price taker because so competitive, so much money, the BDCs, public, private, the asset managers, the banks, the mid-market CLOs, it's really crowded out there. Yeah. So you become a price taker. On the secondary, because of the supply-demand imbalance, you're much more of a price setter. And so you can build into your price, the discount you need to effectively reflect your underwriting and getting to the return that you deem are the fair, value for this asset.
So what can you tell us about the types of opportunities you're seeing? What are the returns like? If you can't talk about returns specifically, what kinds of discounts?
No, I can certainly, exactly, tell you, what we've seen, and we've been deploying. It's been 5 years now. 5 years. On average, our portfolio was bought at 85 cents a dollar, discount to the NAV, and with an average life of let's say 3.5 years left. It gives you, 15 discount, 3 years, 500 basis points pickup to what you would normally get, on the primary. And that, I think, is effectively it's the illiquidity premium or the liquidity premium, depending, which part of the table, you're sitting. And that gets you into some kind of, mid-teen return, And I think that for that, you're fairly compensated for the risk you're taking because you're not the managers, you're effectively getting into in the backseat of someone else, driving the portfolio. But you can build in the cushion to make up for when and if there are more defaults, in the portfolio. That's how we're approaching it.
So it's interesting to me. In some ways, you're kind of hunting for discounted private credit assets right now.
Yeah, well, it's not hunting for, it's where, the market, settles. And here again, you've got different type of players. You've got the real credit investors, and I can think of, some of our competitors and peers really come from the credit and do the bottom-up underwriting. And then you've got on the other side the solution providers who are more like secondary players, and they have more a top-down approach, if I may say. But these two groups, they coexist, together, and that enables to cover, the full spectrum of the market. But you have to do the work. That's the other thing. Fundamentally, you have to do the work and not be, as I said, incentivized just to deploy and overlooking maybe sometimes some big fundamentals.
So as long as I've known you, we've spent a lot of time talking about the importance of good origination. Yeah. So as you do the work, are you comfortable with the marks that many fund managers are putting on their portfolios and the underwriting that's happened by writ large, right? I mean, do you think that people have done a decent job reflecting the true value?
Yeah. Well, I hope they do. That's certainly what we do on our primary business, on our primary direct lending business. On the secondary, the interesting part is that if we're not comfortable, you are once again the one who is putting the price, on the asset. I know there's been a lot of comment, a lot of press around the fact that, some different managers into the same assets might have, different marks. I'm not calling for more regulation, but I'm certainly calling for a better discipline, of everyone's, because here again you've got other buyers. Some people get paid on the NAV, right? And back to my point, if you don't have a strong alignment of interest there, you will have an incentive maybe to, beef up a little bit your marks when there is no point doing that, because effectively, why would you do that when if you're living through the life of the asset and there can be some ups and downs and cycles, and if you're fully invested in your fund as well, then effectively what it's reflecting. So there might be bits and pieces of the industry that needs to be tweaked a bit, in the way it's being approached. And some people have to be honest. I mean, fundamentally, just be disciplined and honest, and you will help, the whole market.
It feels like the evolution of a lot of different markets where you start kind of in a very private place where, there's not a lot of assets trading hands, so there aren't a lot of marks like you would with the stock trading hands. But, another way to ask that question is how much are you passing, right, on assets? How many times are you looking at a new investment and saying, okay, we don't agree with what's underlying here?
Yeah. Well, I can tell you our underwriting, we are converting 5 to 7% of the situation we're looking at. And that has been consistent.
That's very limited.
It has been consistent since 2007, almost 20 years ago, when we started our direct lending business. And that's because, the rule number one of credit is diversification, right? You have to kiss a lot of frogs, to find your prince, as you say, right? So, you have, that's why you need a big origination platform. You need the team. You have to be, that's our job, as owner of the firm, to be able to say no, and even because the investment team, they're in love with their, they've been working 2 months on a situation. Of course, when they come to the investment committee, they want that to go through, right? And that's why you need to be the sparring partner with them and saying maybe that's where experience comes a little bit. And when you tell them, what, maybe what at the refinancing, the base case scenario for refinancing, what is your assumption? Oh, it's going to be refinanced at 5 times. Okay, why don't you do maybe 3.5? Oh, and by the way, SOFR is going to be at 3, and I go, why don't you put at 5? And they compute all that. I say, well, but it doesn't work. I say, well, that's the point, because if you want to make it work, you will always make it work. If you can factor in a little bit of experience and cycles, but sometimes effectively, you shouldn't be doing the deal. And that's that's also another lesson learned, I think. And a lot of people who got burnt into this, moment, I think they will look back and say, effectively, I remember the discussion at the IC, and there was some debate, and we pushed it through, and maybe we should have, stepped back.
So the big elephant in the room when it comes to private credit, first there were questions around, how liquid or not liquid are these vehicles? Then the question before that was, are there cockroaches, as Jamie Dimon called them, because we saw a few losses that were outside really of the private credit space, but it drew questions. And then the third wave was, how many issues are there when it comes to software?
Yeah.
How do you see this issue? Do you think that in general the narrative has been overblown, or do you think that there's actually been not enough attention paid to this issue?
Yeah, well, I mean, if the underlying question is, will AI effectively challenge some businesses? I guess we'll agree to say that the answer is yes, right? And I hope and I think that people did not wake up 2 months ago to the fact that AI, was there and challenging some businesses. I've been asked many times, this question over the past, few months, and I could only give this example that some people, are too young to remember that. But 25 years ago, Sonali, what was the one asset class that all the big buyout firms, were eager to pay a lot of money for because banks, at the time it was only bank and capital market, were ready to finance so much because it was such a resilient credit with such a high margin of cash flow conversion, because that was one business where the customers would never stop paying until they die. They call that the yellow pages. The yellow pages across the world, that was the most hype, asset, that people were going after. Before we knew it, the internet, as we called it, arrived, and in few quarters, everything was gone. So some big disruptions in the market always happen. And, will AI challenge some businesses? Absolutely. And that should be, priced in the leverage you're putting in on your deal, obviously, at the in the structure you're putting, in the deal. But I think there's a bit of that. I think people maybe forgot that credit was about cycles, that those cycles could be, either macro or micro and very, idiosyncratic. And coming back to basics, some assets, they should not be levered more than 4 times. And don't put 6 times just because, the competition was so aggressive. Stick to your discipline.
And then a lot of this too is underwritten, where we saw rates rise in 2022 and then valuations drop off, and also before ChatGPT. So what happens to those vintages?
Well, 2 things. First of all, as you said, it's 2021. So now, we're 5 years later. It's money time, because you have to pay back the debt. So there is this first part of the situation, which is effectively, there is a maturity to the debt, and that's when it's coming due. And that's when you look back and say, oh, effectively, when we did this underwriting, interest rates were so low, spreads were so, and I had a 6 or 7x, leverage on this credit. Well, now, because the business has suffered, everything else being equal, I should be refinancing at 10x, and that doesn't work, obviously. So what happens? You need to restructure, your balance sheet. You need to find more capital. Maybe, you won't be able to sell for the mark that you thought you would be selling for. And kicking the can down the road here, doesn't help. And I've seen those stats where now you started seeing last year and Q1 26, some managers now starting selling below the mark. And I think it's great, because it gets back the liquidity that the market will need. Because these vintages, there will be, if not losses, certainly some underperformance. But I'd rather have, some underperformance to be effectively realized, rather than effectively doing CVs and picking and effectively keep trying to wait for better days, when you should actually more take the pain now and move on.
You're saying investors should bite the bullet with their software exposures?
Exactly. Potentially some of them, yes.
Do you think that some of them have yet?
It's complicated, because it's such, it's a deal by deal, and some of the things we're seeing, and you saw that there's already been some enforcement, some repossession by some lenders. We're generally talking about the very large companies, part of the part of the market, of the private market, with some multi-billion private financing. But you've got all the rest. You've got effectively the mid-market, and you saw that the mid-market default rate has been picking up. Certainly here in the US, over the past 12 months. So it has started already. But again, it's just a natural part of a credit cycle.
So talk to me about how you see this credit cycle, if you believe that we have one coming, is playing out.
Yeah. There's been a lot of money put in the system because of everything we discussed. And this money was relatively cheap, not to say free, right? And so these cycles, of deleveraging, not only at the company level, but at the system level, I think is what we should witness, in the quarter to come. And then on the other hand, you still have this very strong and robust institutional flows, as you mentioned, insurance companies, global capital, some part. You should realize that in the US, private credit is very well established, and people have 20, 30% exposure to that. You take Europe, it's probably 7%, 5%.
Very
you take
underpenetrated.
Asia, underpenetrated, and so as part of this liquidity pool, get into this market, marginally, you create this marginal demand. So,
what's your estimate for Asia?
On the institutional market, if you take Korea, Japan, they've always been big lenders into the system, so probably around 10%. But retail, there were a lot of those late comers. You saw that on the real estate, you saw that on the credit, and they come levered. And you should not put leverage on leverage. That's the other thing, the other discipline that people should stick to. So you've got this strong positive that are effectively supporting the market. And as people get more educated, as people, and I'm talking about part of the retail, part of the institutions, as people get a bit more sophisticated in this allocation, credit will always be a strong, in my view, will always be a very strong part of any investor's allocation.
So one other thing about the software industry that I think a lot of people aren't really coming to terms with is there's the private credit part, but then there's the private equity part.
Yeah.
And let's talk through how this really works at the end of the day, because you're looking at loan to value ratios such that you will have 60 to 70% equity cushion. So what happens to the private equity firms that were exposed to pre-2022 deals? Is this a matter of seeing more losses, or is this a matter of the companies themselves, as you started to say, simply just having to borrow at a higher rate because there are fewer lenders now for them, and those lenders now are demanding a higher rate of return?
Yeah, well, I mean, that's a good point. And, I was really surprised that, some people, brought it up. But as far as I remember, when you're a lender, when you're a first lien, senior secured, normally your position is better off than when you're the first loss, which is called the equity, right? So I think it's good that, you're asking the question, that some people start thinking about that, because effectively, if there is an issue with the credit, there will be big issues, with the equities. And that was not really highlighted so far. On the software space specifically, we know that some companies, might die, from the AI that you were, mentioning earlier, but others will be able, to adjust and effectively benefit from this new tool. So today, I'd rather be a 2026 vintage lender. Even in some of the software, for example, you're mentioning, then being the first loss holder, by being the equity. Now, all that is not mutually exclusive, when you build a portfolio. But by definition, there will be more losses, for the equity holders than for the debt holders.
Now, is this an industry that you're staying away from, or that you would actually look at some opportunities?
We at Tikehau, we've got a 7% exposure. We communicated on that. We're publicly listed. We communicate 7% exposure, to the.
But for future deals.
For future, what will be very interesting now is that those businesses that have to be restructured in some way or recapitalized. That's where it's going to be also a great opportunity. You come through your special ops or whatever you want to call it, and then you do a real bespoke financing structure. But obviously it's bespoke, right? So when it's bespoke, it's more expensive than it's when it's a totally commoditized product like the unitranche or something. So that's where I see an opportunity, that because not everything will go to the to zero, but they might need a little bit of haute couture approach, maybe, and not just one size fits all.
So interesting. So would you say that opportunity set exists today, or is it something that you need to see things shake out a little bit more before it's emerging?
Yes, and the companies, some companies are very well aware that they have to do something now, and so you better start working with your lenders, shareholders, new capital providers now, rather than waiting for effectively the accident when you're 2 days before capital coming due.
Right, that's what I keep telling people when we talk to the investment banks. What they say is the reason this is such a big deal today, right now, is because when you look at 2027, those are when the maturity walls start coming.
Yeah.
So really, it's almost a year in advance that in the background, all the lenders and companies are talking, and really what they're doing is negotiating a higher rate.
Yeah, and yes, you will have to pay up. You have to pay up. Not only your base rates is higher, and for some of the those industry, the spreads, the spreads will be higher. So if effectively your cost of funding was, 6 and now it has to become 12, yes, your P&L looks different. And by the way, if your P&L looks different, what is left for the equity owner, will also look different. So, once again, not all of those companies, will go bankrupt, but they might effectively suffer some earnings pressure, and that comes down to the return for the equity owners.
In other words, you can do well on the credit even if the equity is under some pressure.
Absolutely. And, looking back to, modern financial history, this market, you look at on the long term, the compounding effect of credit, has, most of the time outperformed, public equities or private equity markets.
So interesting. So let's talk about the flip side. Let's talk about the positive side of the artificial intelligence story. There are some mega trends that are very much driving investment right now, and AI can't be ignored. So what angle do you look at the AI industry and say, this is the way that I'd like to get into it?
Yeah. Well, first of all, it's making sure that before starting looking at someone else's businesses, that your own businesses is well prepared and well equipped and well invested, with this new technology. I'm certainly not an AI expert, but I've become totally obsessed with what we are doing, at Tikehau with that. The young kid, running the program for us is 24 years old, and I'm learning from him, every single day. And, I'm being the sparring partner there. So first lesson is making sure that you are well prepared as an asset manager, because our industry is going to be challenged, big time as well. So that's lesson number one. And then effectively be curious when you're being approached by these companies who are developing some new solutions. Effectively, some of them will kill some software proposal, but others, will enable your business, much better. And there will be, and I'm not only talking about the big, hyperscaler and all that. I'm talking about the whole ecosystem, surrounding that. They have to be properly capitalized. That's another lesson, Sonali, that I think we should collectively remember, is that no credit. I don't think that credit should be valued off an ARR multiple. I mean, for me, an ARR multiple is a VC KPI.
Annual recurring revenue. Annual
recurring revenues, and the way I learned credit, it was a cash flow multiple, an EBITDA multiple, an operating margin multiple, and starting valuing a business or leveraging a business of some ARR multiple because you're actually not generating any cash flow. Well, you shouldn't have any debt in the first instance. You should be having only equity. That's what equity is for. So that's the other part. I hope that the market will remember. In the discipline I was referring earlier is, when you lend, the act of lending is giving credit with a coupon, a nominal, and a maturity. And you should be doing the work bottom up on how much debt, at what price, and over which period of time, a borrower, would be able, to sustain this debt.
It's interesting. ARR has become such a big practice in the private credit world, but realistically speaking, the business model of software is also changing. And so I'm wondering how much this will change. There's a lot of companies moving from seat-based pricing to token-based pricing for software. Yeah. Expand a little more, though. I'm kind of curious to see, if you believe that AI is also going to change the investment industry also, what are some of the things that you keep in the back of your mind as somebody who runs a business?
Yeah, well, obviously it goes beyond, the credit part, of our business, and it's across the value chain. So it starts, what is our business? Our business is to raise capital and to deploy that into some businesses, some situation that we believe makes sense. So transforming savings into investing into the real economy. So the first thing in this value chain is the way you interact with your clients, the way you approach clients, the way you portfolio monitor, client exposure, the way you communicate, reporting, with your clients. Then it comes to the factory, okay, the origination factory. How do you make sure that effectively you're using all the state-of-the-art technology, but it's just a technology. I remember, when I started in the industry, yes, Excel existed, but, many things like this digital communication was still, very early, and then, everybody embraced that, and it became part of the toolbox. All right. So as soon as you can embrace all this technology and making your business more robust, more resilient, certainly for the people, also more user friendly. Credit analysis, right? I mean, now you've got some models, so some AI, solutions, where you no longer, put some all-nighters, doing your models. It's approaching the business differently and saving times for our people to do what matters most, is to be in front of their borrowers, in front of their clients, but in live situation. I mean, remember that's part of you were referring to part of the cockroaches or the big default. I mean, most of them were frauds, from what I understand. And so when you get to spend time with the CFO, the treasurer, when you do these type of things, it will not prevent you from not doing mistakes, but it's not just a model telling you, how much you could lend. And I think it's important that we bring back all that, and this AI shift will normally and hopefully free sometimes, for the people in our business to get back to the basics and being in this trustful, relationship.
What you're saying is that even with all of this investment in AI, as an investor, really you have to get on a plane and go visit the company that you are investing in.
Of course, you have to show up and you have to do the work. The short answer is yes.
Judgment.
Absolutely. Yes, judgment. And not, when you become such a commodity of, you raise all this money, you have to deploy, you have to do, and you're losing sight from, the basics of the due diligence. In due diligence, there are the numbers, but there are the people. Because when we lend to businesses, also lending to the people, and effectively going into the factories, and going there and seeing if the stocks and the inventory are effectively there, and yes, just doing the work.
So talk to me about some of the large megatrends that you're seeing outside of AI also, because I think you call them the 3Ds.
Yeah,
yes?
Yeah, we like that, which is, effectively you've got digitalization, decarbonation, and defense, opportunity. And those are megatrends. Those are fundamentally megatrends that started, in a different context and for different reasons. And as much as digitalization, we talked about that a lot, but look what happened on decarb right now. People woke up to the fact that being too dependent, to fossil fuels energies, it was no longer just the issue about is it good for the planet or not. It's just like, can I be only dependent to one source of energy? And this decarbonation play, that we started 12 years ago now, came back with a vengeance, because the past 3 years, people are like, well, actually, all that was just a scam, we should go back to, but the reality, it's not. I mean, look at what happened across the board, from low carbon mobility to energy storage, across the board. And as asset managers, that's where effectively we believe, back to the, our value chain, taking some savings and transforming that into the real economy, that's a massive megatrend opportunity. And the third D, effectively defense. Unfortunately, the world we're living in has demonstrated that capex opportunity, if I may say, because here you need real money, effectively, to face and to finance this new world order. And so, these three big megatrends: digitalization, decarbonation, defense, are going to be capturing a lot of the investment needs over in the short term. And as an asset manager, as someone effectively being there to transform, we are convinced of the long-term opportunity.
What's interesting to me too is that when you think of the 3Ds that you're looking at, all of them are kind of converging, right? When you think about defense, artificial intelligence and technology is playing a bigger and bigger role. Yeah. Decarbonization matters also for the AI story, to your point, 100%. Given that there's just not enough energy to feed all these data center build-outs. And so how does that apply to defense in particular?
Well, first of all, it has to be, as I said, it has to be financed, and it comes down to capex. Yes, you will have to build some factory for the defense industry, the same way you're building some data center for the digitalization opportunity. And as asset manager, that's what we should be, really focusing on, is when we're taking some of these resources and that we are investing in some business, are we doing a good allocation of capital? what is the proper return on assets, on capital, we're going to be making, out of that. And once you've got this mega trend, as I said, which all come down, to resilience in some way, shape, or form, normally, you've got a good configuration, as an investor to play that. Yeah.
So we've touched on a lot of areas, and now I'm going to do the very difficult thing of making you choose your favorite child.
Oh, okay.
So when you think about where the most mispriced opportunities are or the most underinvested opportunities, what looks most attractive to you right now?
The asset class where, the cost of liquidity is appropriately remunerated. And so we were talking about secondary private credit. Here you've got an asset, you've got a supply-demand imbalance, which effectively plays in favor of the investors. This mega trend we're talking about as an equity investors, there is a real capex need, so you're effectively putting some money where there is a real need, of capital. We could have discussed, real estate. Real estate right now, and the same supply-demand imbalance that we've seen, in real estate over the past, 2-3 years for all the good reasons we remember around, the work from home and all that. That's part of an industry that is lacking some liquidity because some banks don't want to deploy more. Some investors cannot deploy more, and so whenever you've got this supply-demand mismatch, that's where we like to engage, and that's why, coming back to the first point and direct lending and private credit, that was certainly in the U.S. too crowded a market, this past 2 years to effectively engage, and now the market, is becoming a bit healthy.
It's also becoming more complicated, right? And before I let you go, I think it really raises the question of what is private credit 2.0. Right? If we spoke 5 years ago, I would say, Mathieu, you run a private credit firm, right? Are there more popping up? What do you think? How are you competing in direct lending? If that was the flavor of the day. But now there's all these new flavors.
Yeah.
And so what does that say about where the market is headed?
Private credit 2.0 will look like much more what was basic leverage finance, 30 years ago. And that it should have, remained. And it comes back to the fact that, doing some ARR financing, no, bad idea. You should be equity capitalized, for these type of businesses. It doesn't look good for the equity return. Well, that's the point, that effectively that's why it should be, financed. So if we come back to good sense, discipline in the underwriting, and as I said, a bit of honesty, in the way you're approaching, your mark and the way you deploy. Credit's the basic of the financial industry and the modern, financial industry. And in a world where there is no shortage of liquidity that can be deployed by banks, by the capital market, by the asset managers, by all these alternative lenders, I really believe we are in a situation where it bodes well for the cycle that we have that we are facing right now. And private credit is not. Credit is not going anywhere. Look at what is happening on the public market, and on the private side, I think it's a maturity. It's a maturity phase. You were talking about the child. Well, it's exactly that. Maybe they were a little bit in the teenager mode, and now hopefully they become more adult.
Very nice. Mathieu, it's been great to talk to you about this. It's been a very interesting moment in the market. That is Mathieu Chabran. He is, of course, the co-founder of Tikehau Capital, and you've been watching The Bridge by iCapital.